Hey everybody, and welcome to tonight's options trading Q&A. In tonight's session, we're going to talk three big things. Number one is how fund managers trade options different from most retail traders. I think you're going to be really interested in John's opinion on trading calls and puts versus setting up spreads and other complicated. I guess John's going to say they're not really complicated. Number two, how to assess volatility before you place a trade to know whether it should be a credit or a debit spread type of trade. And number three, we're going to cover how to script your trades so that it's easier to see consistent gains, assuming it's a good trade idea. And obviously, we're going to introduce John Napolitano. John, let's hit it off with a bang. What was the biggest trade that you put on when you were on the institutional side of things?
Hey, everybody. How are you, Pete? Yeah, it's funny. There were many, but one of the largest ones that I remember when I was back in my institutional trading days was actually a Japanese stock. And Japan is a little bit weird. A lot of the companies are family owned. A lot of them are cross owned by other companies. So it's hard to put a very large block together. But there was $100 million ticket I did all in one shot. Wow. And it was just a matter of putting together a deal between the broker, myself, and obviously the family members of that company. So a lot of institutions move in the shadows. That particular $100 million block got put up in one print in one shot, and it didn't even hit the market until the afternoon because in Japan, it's a little weird. They have an AM and a PM session. So we were able to kind of slip that in under the radar so nobody would even see it. So that's the kind of stuff that goes on the institutional side here in the U.S. as well.
Actually, it seems like we're going to end up working towards they're calling it 24-hour trading now. If they do AM and PM, that might break it up a little bit better. Remains to be seen what the liquidity is going to be like. I know it's big on Forex.
Yeah. I mean, I think that's going to change things a little bit as far as the algorithms go and as far as AI goes and stuff like that. You'll have 24/7 activity. But they're going to have rules in place for like when large prints come up and when, there probably is going to have to be some sort of break at some point, you know what I mean, just to kind of keep things level. And then obviously the stop limit laws, like if there's a big crash, like a 10% move in the markets or something like that.
So we want to set the agenda for tonight, John. One of the biggest things that we hear in our community, especially from new people that come in, is the difference between a lot of people use options for the big hit, the big home run, where there's a lot of leverage and kind of buying the out of money calls, that kind of thing, hoping for a lottery ticket, versus what I think most professional traders do is we're more concerned with the probability of profit than necessarily hitting home runs. And I think that's the direction we're going to go in with this tonight.
Yep.
Maybe you could kind of give us an intro into that.
Yeah, that's the biggest difference, I think, between professional option traders and some people who are just a little bit more new or just want to speculate because of the leverage. Low probability trades will give you a low probability outcome. And what we really want to focus on are putting together trades that make sense, that are smart, that are based on what the market is giving you, and things that actually help you mitigate your risk. And that's why it's so important to put together the right strategy at the right time. When you're just shooting from the hip and you're doing out of the money calls or out of the money puts, you might get a home run, but it might be 1 in 20. You know what I mean? And the other 19 are going to be failures. So how much capital are you going to expend before you get that home run? And that's what a lot of people overlook, unfortunately.
So we want to be clear about who we're speaking to tonight. This is really, really important. We want to make sure that you're in the right spot if you're watching this video or if you happen to be watching the replay. It's people that really desperately want that second type of income, maybe to supplement what they're making already, have tried trading options, and there's information overload. And the second part of that is the consistency, not only trying to figure it all out, but then the consistency that they want. So if you've tried and failed and the information overload, not sure which one to use when, you're in the right place. That's what we're going to cover tonight and how to achieve that consistency. And we're going to talk about John's mapping out the trades, which he calls his tests outline for the trade. We'll get to that a little bit later. But first, we want to start out, obviously, tonight's options trading Q&A, open mic. We had a bunch of people post questions. That's what we're going to talk about tonight. If you have any new questions, put them in the chat. We'd love to hear from you as well about that. One big thing about tonight, everything we speak about tonight is for educational purposes. It's our job to help you make better decisions, but it's up to you to make the final decision. That's really important. John, let's actually give everybody an idea who you are and why you might be qualified. Give us a little bit of a rundown on your history here, all the way back from those gold bars to the New York Stock Exchange to your relaxed look in Miami right now.
Yeah, that is a very, very bad goatee right there. I apologize. It was, I guess it was cool back then. But yeah, so I guess I'll start with that picture because it's the most embarrassing. That picture was taken somewhere, I think, around 2002. I worked for a very large institution, a fund manager, and we were one of the very first mutual funds that actually bought the real bullion. We had, a lot of funds buy the futures or they buy the GLD, which is obviously the ETF. My bosses wanted the real deal. They were afraid of, and this was actually, right before the financial crisis. So it's kind of funny. They were like, that was the HSBC vault. And HSBC offered us unallocated gold, which basically meant it stayed on HSBC's balance sheet, but it was cheaper. It was cheaper because it was theirs. So it was kind of ours, but it was under their name. So we were like, no, we want the actual allocated gold ourselves. And I was like, well, why do you want to spend the extra money? And my bosses were like, well, what if HSBC goes bankrupt? And I was like, that'll never happen. You know what I mean? And then, and luckily they didn't, but I'm just saying that was before Lehman Brothers and Bear Stearns and all that other fiasco. You know what I mean? So they ended up being right. So we actually were buying the gold bullion. So I have about, 25 plus years experience as an institutional trader. That other picture was me, ringing the closing bell there at the New York Stock Exchange with some buddies of mine. And it was always, it was a great time. It was a great part of my life. I said goodbye to that world somewhere around 2016, 2017. I started prop trading. So for those of you who don't know what that is, that's obviously trading your own capital, working for a firm, but using their leverage, obviously, to kind of eat what you kill, so to speak. So I was leveraging my skill that I learned over those 20 years to become a successful prop trader. And now I'm living in Miami. I'm coaching. I'm part of the community with you, Pete, obviously. And it's been fantastic ever since. So I have a much more balanced life, let's call it, where I value my time over anything else. And that's really the freedom that options trading and trading gives you. It allows you over time to get your time back. And that's really the key. And that's I hope what a lot of people want out of this call and out of potentially trading options. You want that extra income stream, but eventually you want to be able to retire with enough money. You don't want the stress of having to work 40, 50 hours a week. And that's exactly the lifestyle that I was able to develop over the years.
So, John, just for some clarity, I don't want to misquote the number. What was the larger fund that you worked for? I believe it was a global equity fund.
It was a global fund. It was equity and fixed income, but it was a global value fund. So it was go anywhere fund. That's why we had the gold bullion. We traded currency. So wherever there was value, we went after it. So it was at its peak, it was about $43 billion while I was there.
Wow.
So I was the head trader for that group. And there were a couple of different mandates. We had an international mandate as well as a global mandate. So it was a lot of, like I mentioned Japan earlier, it was a lot of global trading as well. I really fell in love with options around 2008 when the you-know-what hit the fan. You know what I mean? We were able to, preserve a lot of capital by hedging and by doing stuff with options that I was familiar with it, but I never really saw it in action until those days. You know what I mean? And that's really where I kind of fell in love with the idea of, options for protection as a portfolio manager. But also I saw the leverage capability and what it could do as far as mitigating risk and getting return at the same time. Obviously, as a trader, you know what asymmetric risk is, right? It's basically you want to try to maximize your upside with minimizing your downside. And options really give you that opportunity. You could really you can maximize the leverage using options, but at the same time, sizing correctly allows you to have multiple trades at once. It allows you to be long and short at the same time, depending on market conditions and what the market's giving back to you. And it allows you to really maximize the capital that you have. Because let's face it, everybody has just a certain amount of capital, no matter how wealthy you are or not. Everybody is dealing with a certain number, right? And that's the key, maximizing that number.
So we're going to get right into the questions, John. Over the last week or so, we had a bunch of people submit questions. If anybody who happens to be live on the call with us right now, absolutely drop them into the comments. We'll get to them as we're going along here. I believe we have roughly a dozen questions. So we're going to hit right out of the gate. What can retail traders learn from institutional trading habits, particularly around timing, rotation, and a portfolio mindset? I know that's a lot in there, but let's dig right into it. Let's help everybody.
I'm going to pick it apart step by step. So first off, we mentioned what retail traders usually, the first mistake I would say they make are they're thinking about profits, and they're thinking about hitting that home run that you mentioned, and so on and so forth. What institutional traders try to do is they try to find a repeatable process that allows them to be consistent over a very long period of time. So in summary, my strategy and the strategy of institutional traders is not one single trade should matter. That's probably the number one theme we always talk about in our community. And what I mean by that is, you're basically going to be trading multiple things. And it might sound confusing because, oh my God, I'm trading all these different things, but it's not, in the sense that you're putting together a basket that's not going to be traded all at once. It's going to be adding things and taking things off in a very methodical way, depending on what the market is giving you. And that's really what the process is all about in a nutshell.
So to give some context to that, John, when people watch your training, a lot of people ask, it sounds like building a portfolio is very active, and they don't really want to be super active. How long would you say, on average, do trades last?
Yeah, that's the thing. It's funny because most retail traders, they always say, oh, I don't want to spend too much time trading, but they end up glued to their screens because they're watching like one or two things. Their whole life depends on Tesla or NVIDIA or something like that. You know what I mean? My process, if you look at it, let's say on a Sunday evening while the market's closed, Monday morning, depending on your work schedule, what have you, you're looking at maybe a couple of hours a week of analysis. You know what I mean? With maybe a little bit of a, hey, let's adjust things midweek. Let's take a look at what's going on, if anything has changed. And that's really what it's all about. So you're talking about a few hours a week. When you're new, it might take a little longer, obviously, when you're new and you're learning. But once you get going and you get this process in motion, you're dealing with trades that you're going to be holding on to for days or weeks. So you're not going to be so active as you think. You know what I mean? You're going to be talking about making small adjustments throughout the week, either taking things off or adding new things, and so on and so forth. As far as timing and rotation, again, I keep saying you're going to trade what the market is giving you. You're not going to trade what you're hoping for or what you're trying to predict the future or what you're wishing for. Obviously, with the times that we're in right now, there's a lot of headline news out there. And I think headline news has dominated the news cycle in the last couple of months. It's pretty much impossible to know what the heck's going to happen tomorrow. So what you really have to do is look for trend, follow what the institutions are doing, and try to get on board when they're getting on board. And that's really what it comes down to. Institutions make up for, 80-90% of the volume on the New York Stock Exchange. So I think it's pretty darn important that you copy what they do. You know what I mean? And what's good about it is they're big. They're billions of dollars. So they can't pile into something in like 5 minutes like we can. That it takes them days and sometimes weeks. Some of those trades, if I didn't get a block trade together, like I mentioned earlier, it would take me, if I wanted to kind of methodically add a position, it would take me weeks. Even if it's a liquid name like Microsoft or something like that, I wouldn't want to dump it all in one day or buy it all in one day. I'm going to be kind of piecing it out. So institutions go into things, they pile into things kind of methodically. And by following that rotation, by just learning the signals in order to do that, you're basically starting to build a watch list every week that's in alignment with what the rest of the market is doing, instead of kind of hoping and wishing and praying for what you think might happen.
So I think two big lessons there, John. If you don't mind, I'm going to try and summarize each of these points because I want to make sure everybody takes the benefits home of everything we're talking about tonight. Number one was the first thing you said, which was, I think that most retail traders, matter of fact, I know for a fact, live and die on that one position needing to work, and it stresses them out of their mind. And what we're talking about tonight is learning how to build positions, again, based on sector rotation, based on grading the market, and always kind of doing a dance with the market where we're looking at relative strength, relative weakness, and building those positions so that one trade, we're not betting everything on one trade, we're betting everything on the probabilities unfolding. Is that correct?
That's 100% correct, Pete. And when you're putting together a basket, let's say of 10, 15 names, just as an example, there's less work involved, because once you pick the sectors and you pick the group where you should be in and where you should be long or you should be short, the rest kind of takes care of itself. You place the order, you have your stop losses in place, and then you make small adjustments throughout the week. And what I mean by adjustments is you either add as momentum favors you, or you start to take away if your edge starts to disappear. A perfect example, I had a situation once, this was back in 2017 when I first started prop trading. I had a situation where I sat next to a gentleman who loaded up on Chipotle, right? Not the actual food, the stock, right? And what he was doing was, you have to keep in mind, 2017 was a pretty stable time. The market was kind of just drifting higher. I don't remember what the return was that year, but it was kind of slow melt higher, basically, kind of nice and even. So he was loading up on this stuff, and it was a very popular stock back then. It was, it was doing really well. And then sure enough, they had that, I don't know if you remember, they had that E. coli breakout. Remember, people started getting sick. So he lost about $60,000, $70,000 in a matter of 15 minutes. And it basically wiped him out. It wiped out his whole career. They had to let him go. He wasn't, he was putting all his eggs in one basket. And I remember all he talked about was Chipotle for an entire week. And I was like, there's got to be a better way to trade than to just like go to bed worrying about one name. If you're going to bed and you're thinking about a stock, number one, you need to get a life, and number two, it's too big. It means it's too big by definition. If you're thinking about it at night, it's too big. That's like rule number 2. You know what I mean? That's the best thing I could tell you.
Okay, let's hop into the next one because we've got a lot to cover here tonight. This is awesome.
Yep.
All right. So next one is, why is it important to build a diversified basket of trades instead of relying on only 1 or 2 stock picks, especially when trading options? Now, one thing you say all the time is that there's a lot more options with options.
Yes.
There's more ways to put them together.
Yeah, no pun intended. So, yeah, I think, when you're putting together a diversified basket, it actually reduces risk, because when you're thinking about, single stock risk, and especially in today's news, today's headlines and stuff like that, anything could happen at any time. So it makes sense to find the right names within the right sectors to go long, and then obviously the most horrible stocks and the most horrible sectors to go short. And then you could put together your strategies once you put together that watch list. So it's a step-by-step, top-down process. It's nothing, it's nothing super, super difficult to master. You just have to be consistent. You have to kind of stick to the rules and make sure that you manage your risk. And options give you those choices. It gives you the best ability to manage risk in the most effective way possible. Because let's face it, like I mentioned earlier, if you have a certain amount of capital, doing this strategy with stocks is a little more challenging, because obviously it requires more capital to make the kind of return that you can with options.
So 2 things I want to make sure that I want to keep reiterating the summaries of everything. That's twice now you mentioned that we're following the market and the relative strength and weakness, versus what I think a lot of retail traders do is the first question is, where do I think it's going, as opposed to flipping the script and saying, here's what it's doing now, and we're going to monitor it. As long as that's still valid, the trade is still valid, as opposed to predicting where it's going to go, which you have absolutely no control over, which is really much easier to do.
The reason why trend following works is, I would say, 99% because of institutions. Like I mentioned, it takes time for an institution to build a position. So when you start to see something break trend, when you start to see something move in the opposite direction, when you see a reversal, that's a little bit of the early warning sign. Then you start to see it maybe above its moving averages. You start to see heavier volume. There are all kinds of signs that tell you that, hey, this is the name I should add to my watch list. And we talk about this in our community, like what are the steps to do that? And that's what we go through in our screening process. But it doesn't take very long, because your watch list is going to change every week. But you'll get some of the same names that end up on one week to another. But you'll be taking some off and adding some on as things play out in the market. So it's kind of fun. It's like you're playing a little bit of detective work. And what also, another kind of byproduct of this process, which I think is really fantastic, is that it takes away the bias. It takes away I know that stock. I've been trading it for 5 weeks. I know how it's going to behave. You don't know anything. You know what I mean? You don't know what's going to happen tomorrow. And by doing our process that that we do every single week, it allows us to kind of get that unbiased list every single week, where we could say, hey, this, these all got qualified based on my process that I've perfected over the last several decades. This is what I'm going to stick with. And that's really what it's all about, because institutions control the market, let's face it. And you have to kind of follow when they're starting to rotate into things. It really makes the most sense.
So you've mentioned a couple of times now, following the market. We're going to get into it, just so everybody knows. We're going to get into actually looking at the market, grading the market, and grading the sectors, which ultimately is where the trade ideas themselves come from. So make sure you stick around. We got a lot to cover here tonight. All right, so next question is, how does implied volatility affect the selection of option strategies, and what are the risks of ignoring volatility conditions?
Okay, so implied volatility is basic. So I like to call volatility in general like your second gas pedal when you're looking to go long or short an option strategy. So there's two things to think about. The overall volatility of the market will make all option premiums expensive, whether you're going long or short. So puts and calls get expensive when volatility increases. Now, implied volatility has to do with the individual stock. So there could be a news or sector specific reason that the implied volatility of a stock or a group of stocks will start to increase. And you have to be aware of that before you place an order, because if you're placing an order when volatility is high, whether it be both the VIX or implied volatility of the underlying stock, you're overpaying for your option. And if you're overpaying for your option, you're not going to make the profit that you necessarily think you might get. Your risk reward setup will be a little bit skewed in the sense that you're overpaying. So your risk will be increased and your reward will be diminished. Now, conversely, if you have a high volatility environment where vol is high or implied vol is high, you could be in a situation where you can be an option seller. What's great about being an option trader is that you have four main choices. You can be a put buyer or a put seller, or a call buyer or a call seller. When you're a seller of an option, you can be both bullish or bearish. And now what you're essentially doing is you're allowing for volatility compression. You're basically going short volatility. You're entering a sale position and you're allowing for volatility to compress. So those are the four choices essentially that comprise every single strategy that's out there in the option environment, and you have to just be aware of those four choices.
So, John, I want to ask you a question. I know I've seen this on my side of using options, but I'm obviously not teaching them and coaching them the way you are. Have you encountered people who don't really understand the difference between an expensive option versus they can afford to buy it?
Yeah, it's when I mean expensive, I wasn't even talking about like the size, their account size. When implied volatility is upwards of 50%, I could guarantee you that your premium is too expensive. You need to be doing some sort of other strategy besides a long call or a long put. Now, when an option, if you're buying an expensive stock, the underlying option is also going to be expensive. So when you're talking about a four-figure stock, the option will probably be pretty expensive too. So you have to be careful with your sizing. So those are the two main differences. Like you can buy a low volatility expensive option and it still be inappropriate for you if you have a small account size. You know what I mean? So you have to be careful. But really, when I say expensive, I mean you're overpaying for that particular trade. Your reward to risk, your break even is no good. If you buy an at the money option for $100, let's say a strike price of $100, we'll keep the math simple really quick, right? Let's say you pay $5 for that option, your break even is 105, right? So it has to increase by 5% in order for you to even break even. If now, let's say volatility increases and now you have to pay $10 for that option, let's say doubles, right? Now you have to have a 10% increase of that stock during the time period that you own that option in order to even break even. So you got to be very acutely aware of how much you pay for your option, what your break even is, and what your risk reward is.
Okay, let's hop into the next one. All right, when is it appropriate to use debit spreads versus credit spreads, and how does the volatility environment influence that decision?
Yeah, that's a huge, that's a huge thing because a lot of people are like habitual debit traders and habitual credit traders. I like to consider them all tools that you can use in your toolbox. So for those of you who aren't familiar with the difference, again, I mentioned earlier that with options, you have basically four choices. You can be you could be a long call buyer and a long put buyer. That makes you a debit trader because you're paying for that option. Whenever you're paying for something, you're a debit trader. Okay, so when you put together a spread trade, that implies a two-leg strategy where you're buying a call, and let's say you're buying a further out of the money call to kind of soften the blow and make the cost a little cheaper. And those are very preferred strategies in higher volatility environments. But it's still a net debit trade. Now, a credit trade is something different. That is when you sell an option, you receive the premium. Now, when you sell an option, keep in mind, you have an obligation. So now you're basically naked, right? You basically have assignment risk of either being short 100 shares or being long 100 shares, depending on whether you're selling a put or selling a call. Most people don't want to do that. So what a credit spread does, it allows you to mitigate that by, again, buying an out of the money put option or buying an out of the money call option to offset that assignment risk. So it's defined risk, defined reward on both sides of the debit spread as well as the credit spread. But really, when volatility is extremely high, you're better off leaning towards credit trades for a couple of reasons. First of all, when volatility is high, it usually means the stock market is going down pretty hard. And Pete, you know this, the biggest rallies usually happen when, right? In bear markets, right? Mm-hmm. So it's very hard to try to go short and kind of try to assume that it's going to keep going short. Because at one time you just buy that put option, let's say, you'll get that 10% bounce in one day, right? And you'll get completely wiped out. So what's cool about a credit spread in an environment like that is you can do a bear call spread where you're selling an out of the money call option, you collect a little bit of a premium, and it allows you with that high vol environment to take in that premium. And all the stock has to do in a situation like that is kind of stay where it is. It doesn't have to it could even go a little bit higher if you do out of the money. It allows you to receive a premium. You're still bearish, but it kind of allows you to sit through a crazy environment. You know what I mean? So that's when those are appropriate. When markets are more normalized and they're trending, debit spreads tend to be a little bit more appropriate. You know what I mean? And that allows you to kind of have a directional bet, either long or short, and it allows you to offset some volatility by, again, selling an option on top or underneath it. So these are all strategies we teach in our community, but they all serve a purpose, and you have to know when to use which one and obviously when. You know what I mean?
So debit, credit, volatility. Let's bring this home a little bit.
Sure.
How'd you handle April?
All right. So April, basically everything was kind of falling apart. Wheels were coming off the bus, right? Technology was in the tubes. But again, I think there was that one day, was it April 8th or April 9th? You had that massive rally. You know what I mean? When there was a little bit of possible relief from the tariff. So they were kind of taking a little break. If you pull up SPY, that one day, you see that big bounce. What if you went short the day before? Everything told you to stay short, right? And look what happened. That's what I mean by the nastiest reversals happen in bear markets. So, credit spreads work pretty well in that type of situation because you can sell an out of the money option. You could sit through that nonsense, that bounce, and then now you see how things are rolling over again. You could have been profitable. Now, if you would just, let's say, long put options, let's say you were super bearish, right? You thought everything was going to fall apart. You would have got your butt handed to you that day. You know what I mean? And you probably would have ended up losing a considerable amount of money. So these spread trades work really well because you can sit through this type of choppiness. You know what I mean? And again, it's defined risk, defined reward. So essentially you can plan ahead. You can kind of plan what your maximum pain would be and what you're willing to sit through.
So John, just in the context of April, obviously everybody knew there was a big announcement coming and it rocked the markets. So how did you adjust trades you might have started heading into April in the context of this massive spike in volatility that now apparently has contracted quite a bit,
Yep.
almost to the point of where it exploded in the first time. Can you walk through the thought process of managing trades where volatility expands rapidly and then contracts?
Yeah, what you essentially want to do is when volatility is expanding, you essentially want to be in debit trades already, because volatility is essentially a second gas pedal. As volatility expands, your premium will expand as well, all else being equal. So when you're long an option, you have time against you because time is not on your side. Your option is melting away every day as it approaches expiration. But volatility, if it spikes up like that, again, every single premium will benefit from that. It'll increase because there's uncertainty, and now options, market makers and so on and so forth, they're going to have a tough time pricing what the value of certain options contracts might be, 1 week or 2 weeks or 1 month out. So what happens is spreads widen, and you have a very large premium starts to increase. So essentially what you want to do when you start to see volatility spike is you want to try to get long debit trades. Now, once it's already too late, let's say you wake up and the VIX happens to be at 50, which could potentially happen. What the VIX does tend to do, over time, there are exceptions. Obviously, during COVID, the VIX was elevated for quite some time. But under normal circumstances, when you have like a run-of-the-mill correction, and there's no sign of recession, which there isn't right now, there's just, obviously a little uncertainty with tariffs, chances are you get the volatility, which is pretty typical, which is what you see right in front of you right there. You see a huge spike because there's uncertainty. And then once the market kind of gets used to it, it kind of normalizes the activity. You start to see the rollover, and that's exactly what's happening. So in that environment, you want to be short volatility. So you want to be short and have credit trades on and just take advantage of that volatility compression.
So there's a lot of language here, right? So you might have somebody who's brand new, learning everything you're saying. And again, we started today out talking about the biggest problem that people have is information overload. Obviously, when you're giving your trade alerts out, you're explaining all of this, right?
My trade alerts are step by step. So essentially, I always start off with, why did I pick this? Why am I getting it? What's my justification for picking this name at this time? Out of all the 10,000 other choices you have, this is what I think we should be doing and why. Okay, that's step one, my edge. Now, my edge is my thesis. It kind of builds a case for, like I said, why am I getting into this trade in the first place? Once I do that, then I get into basically what my target should be. So every good trader should know when they're getting out before they get in.
So let's give a sneak peek, John, if you want to walk through a trade that happened to have been in the newsletter recently, and you can walk through the steps.
Yeah, absolutely. So what do we got there? Oh, that's really recent. Okay, so that's basically, you can see it's an industrial sector. It's Copart. And you can see that my bullish case is right there. So right off the bat, I kind of illustrate, what sector it's in, whether I'm bullish or bearish, and then I get into what my overall thesis is, or my edge. The stock is in one of the best performing sectors. So when I perform top-down analysis, I'm looking at the overall market, I grade the market, I decide what my basket should look like. Should it be bullish? Should it be bearish? Like in a theoretical basket of 10 names, how many bulls should I have and how many bears should I have, right? That's step one. Then once I get into the sectors, I start figuring out, well, I want the best of the best. So if industrials happen to be the best of the best that particular week, I'm going to search for industrials to add to my baskets. That's exactly what I did in that case. So this stock is in one of the best performing sectors, and this group will likely go higher if there are any tariff resolutions. So on the downside, on the downside with the 90-day pause, the group will likely not see much further decline. I'm kind of building a case here. So the first thing I do is I will look to add bullish exposure in a name that has limited headline risk in the near future. So basically I was saying, the news is already kind of out. It was priced in, and if there's a pause, that could cause a pop and so on and so forth. So I'm building a case. It's also in a favorable group at the time. So it kind of had that momentum where institutional money was going into that group to begin with. So if the market was to roll over, maybe that one would still have a little bit of relative strength. So I'm also kind of saying from a risk standpoint, this one makes sense as well. Now, the next thing I do, once I kind of build a case for the particular stock I want to get involved with, I have to pick a target. And I do that based on technicals. I'll look at resistance, I'll look at support, I'll see where sellers came in, prior, and so on and so forth. So in the sense of this one, it was $62. I also said I'll monitor market conditions. Now, if tariffs get lifted and the whole world is rosy and there's unicorns and rainbows and everything else, I am going to look for a secondary target, right? But my first target is 62. But if things clear up and the markets rip to new highs and everything else, I'm going to stay in this trade and I'm going to look for a secondary target. But my first one is 62. That's kind of what I'm targeting to start with. My next situation is I'm going to look for an entry. So current levels are okay. So usually when I'm looking at a chart pattern, I look for a confirmation entry. I look for a bounce off of a moving average. I look for a confirmation candle. If I don't see one, I might wait an extra day, or I might scale into a name if I think that, let's say, it could go a little lower before it goes higher. But essentially, I'm looking for an uptrend, something that's above its moving averages, but I essentially want to see some sort of reversal. I want to get a pullback into an average, and I want to see it kind of bounce back into trend. So I'm looking for a viable entry point. So current levels are okay. It pulled back. If it pulls back a bit further on Monday open, I'll watch to see if the action stabilizes or drifts lower. And again, so I'm looking at that 20-day moving average in that particular example. Now, when it comes to leaving a stop, this is where options are really, really beneficial, because let's say whatever price I paid for that particular option, I can put a hard stop of 40% on that thing. So let's say, if I pay $10 for an option and I put a 40% stop on, the second that option hits $6, I am out. I place a market order ahead of time. That's already out there, good till cancel. So the most I'll lose is $4 out of $10, or 40% of that particular situation. And then after that, my time frame, how long do I think it's going to take to get to my target of $62? That's going to basically determine what expiration date I'm going to use too. If I think it's a slower moving stock, maybe I'll go out 2 months. If it's a quicker moving stock, I'll probably go out 1 month. But for a debit strategy, it's one of the rules I have. I generally go out more than 30 days because I want to avoid excessive time decay, which we talk about in our community. That's the enemy of option traders when you're a debit trader. When you're a credit trader, time is your friend, because you're holding an ice cube that's melting, and that melted ice cube goes in your pocket. That's your premium. When you're a buyer, that's bad news. You want it, you always have to kind of outperform theta decay. And then sizing, obviously, based on your stop, based on your account size. Generally speaking, I stick to a 2 to 3% rule, which is, I think, what most traders kind of have in their rule book. And that's basically, I'm not going to risk more than 1 to 2% of my portfolio on any single trade idea. So I kind of back into the number of contracts I'm going to buy based on my stop and my sizing. And that's essentially what I'm doing. So then finally, after I know exactly what I'm doing, I know exactly what I'm getting in, what I'm getting out, why I'm getting in the first place, I then put together my strategy. Now, in this case, this was a little bit, I remember this one. This one was a little bit unusual because volatility is really high, right? Now, but look at the implied volatility at this one. It only stands at 27%, which is fairly low. So I was comfortable just doing a straight call on this one. Although markets call for credit strategies and spread trades, this name does not offer weekly expirations because it's a little bit more of an obscure name. I love trading obscure names, by the way. I don't like trading the popular stuff because, again, I don't want to have any bias. I want to trade stuff I've never done before. I like trading new stuff every week. And stuff pops up on my watch list every week. And this particular one didn't have weekly options expirations. So there was some strategies I wasn't able to put together for that reason. So straight calls were appropriate. And that's pretty much the end of it. I placed the order. Straight calls were appropriate because volatility was, low compared to what the market was doing. And then I always throw in a chart there and I kind of show you where I think it might go. Now you can see that little circle that I drew. I was saying in the target that, you might want to wait 1 or 2 more days for a pullback. Now, if you're an aggressive trader and you're comfortable sitting through a pullback, there's always that risk of missing it, right? If you don't pull the trigger and it never pulls back, you might never get in the trade. But if you're a more conservative trader and you want to try to get in where that little circle is, you might want to wait a day or two for a little bit more of a pullback to see if it actually does. And in that case, you can see there that there's a pivot point at 62, which is where I drew that second arrow. And obviously, there's a secondary target there too. If markets take off, you can see there's even a third target up there on top, which I didn't draw, but you can see that there is room for this thing to run if markets cooperate.
Okay, so let's hop into some more questions here, John. You kind of touched on this just a little bit before. In what ways can volatility serve as an extra gas pedal in options trading, and how should they handle sudden spikes in market volatility?
Yeah, so initially, what you really want in a perfect world is a market that's trending in a low volatility environment, and then be in the stock at the right time when vol increases. That allows you that extra gas pedal. Now, sometimes it could happen within a specific sector or a specific stock. So forgetting about the crazy markets we've been in lately, a good example would be semiconductors. Let's say, if there's let's say a tariff, or let's say tariffs get lifted on semiconductors, right? You'll see an explosion in volatility because, premiums will expand, markets will rip, and you will see, that's the kind of situation where if you just go long that whole group, you could take advantage of volatility. And also, if a volatility spikes, you can then look for volatility compression once all the news is priced in. An example of that is during earnings. We're in earnings season right now. A great strategy to utilize are credit spreads, or even iron condors, which is basically a double credit spread. You're essentially waiting for the news to kind of come, and you're basically picking a strike zone where you don't think the stock is going to go much further out or much further down, and you'll win as long as the stock stays within a certain range. Those are great volatility strategies that you can use, and that allows you to capitalize on any spike or reduction in volatility.
Okay, next question here. How does grading the overall market help traders align their strategies each week, and what factors should be considered when assigning a market grade?
Okay, so the market in general, I have a very simple approach. I look at the major indexes. So I start with obviously the SPY. I look at QQQ. I look at Dow Jones, even though it's a smaller index, obviously. And what I try to look for is overall trend. I use moving averages and volume to determine how strong the trend is. And then what I'll do is I'll grade the market based on price action of that trend. So is current price above both moving averages? Are both moving averages sloping upwards? If the answer is yes, then I would give the market a high grade. I would say, hey, the market is trending higher. Moving averages are going in the right direction. There's good volume. Then the next thing I'll look at, which is a little bit of, I don't want to call it subjective, but another thing I'll look at is overall market sentiment. How has the economic data impacted the overall price action of those markets? So besides looking at the technicals and the charts, like I just mentioned, the next thing I'll do is say, well, has good news, sometimes good news is good news and bad news is bad news, but sometimes good news is bad news and bad news is good news, right? So, and people who have no idea what I just said, what I mean is sometimes, when sentiment is good, bad news gets ignored and good news gets rewarded, right? When sentiment is good, right? When sentiment is bad, good news might get ignored and bad news will get punished, right? So how did economic data react this week? That's something I factor in as well. So if sentiment is good, I'll maybe give an extra letter grade or half a letter grade to the upside or to the downside, depending on sentiment. Also, I look for continuity among the major indexes as well. If the NASDAQ is downtrending, but the S&P is uptrending, I'm going to assign the overall grade a little lower, because usually when one group gets sick, the other group catches a cold too. You know what I mean? Over time. So that's
I like that.
Because they're all correlated to one another at some point. So if the NASDAQ is just dragging the entire market higher and the S&P looks pretty sick, I'm not going to be so happy about putting my money into other sectors besides technology, let's say. So that's not a healthy market to me. And we had that actually, right, in the beginning part of the year and last year. And that's something that was always a concern of mine. How long can the NASDAQ, these magnificent seven stocks, keep the other 75% of the market up? You know what I mean? And that was always a concern of mine. But I was still bullish. That's the thing. Like, when trend is trend, I'm cautiously bullish, but I'm still bullish. But my letter grade won't be an A+, it'll be a B minus, let's say. And that's where I start assigning some bearish trades to my basket just to offset things.
Okay, so a big question we do get, which is how often should you be regrading the market? We already covered comparing it to the benchmark of the S&P 500. How often should you be coming up with a new grade?
You know something? It doesn't change all that much, but if there's significant news during the week, if there's major shift in sentiment, you should regrade the market midweek, I would say. You should definitely take a peek. It takes only 2 seconds to look at an SPY chart, so it's not that big of a deal. What you really want to do is look for change in trend, and if anything major happened that caused the trend to break. I would say you want to definitely take a look at it midweek to make sure nothing major occurred. In our community, I give a weekly recap on Thursday, which basically says, hey, we should maybe add some more bullish exposure. Or, hey, maybe we should add some more bearish exposure if anything does change. So sometimes nothing changes. Sometimes it'll just keep trending in the right direction.
So one thing I want to be clear, though, you're doing all this work for your community.
Absolutely. So
the alerts that clear to everybody tonight.
Yeah, so I provide alerts and trade. In the newsletter, I provide basket ideas. Obviously, you have to come up with your own ideas. What we want to do is teach you guys how to fish, obviously, not just hand you fish, but we show you the step-by-step process in the meantime. So this way you can practice and learn. And in the community, in the coaching community, you could ask questions and kind of build your own strategy and your own consistency. On top of that, again, I grade the market in the newsletter as well as intra-week in Discord and in the recap as well.
So next question, why is sector rotation analysis essential to the trading process, and how can identifying institutional money flow improve trade selection? So obviously you're an institutional trader. How are you looking at the market differently from an institutional perspective than somebody who's just looking at technical analysis?
Yes. So what a lot of institutions will do is they'll be a lot more tuned to other factors that a retail trader might not be aware of. When you're a retail trader, again, you're kind of in this, you're watching the news, you're kind of tunnel vision at the stocks that you're focused on, and you're not focused on maybe what the global environment is or what the economic environment is or what the bond market is doing and what the volatility index is doing. Institutions have a lot more resources and time and teamwork than we do. They have teams of people doing this stuff. So when they pile out of a sector, you will know it. You will see it. You will see a sector just sell off rapidly. And if you happen to be in that sector, if you don't have your risk management in place and your edge is starting to disappear, you can get run over pretty quickly. So what you want to do is always be aware of when the individual sectors are starting to change their bullishness or bearishness. And again, it goes back to technicals and it goes back to broken trend. And institutions tend to pull out of things it takes them time. So this isn't something that's going to happen over the course of like one day. Sometimes you'll get like a 1 day rotation, but usually these types of rotations will occur over the course of several days, and you'll be able to notice it. Now, if you happen to be unlucky in the sense that let's say you're long a stock in a certain sector, and let's say that sector comes out of favor, your stock will start to underperform. Now, it might not be at stop loss, might not be at a stop loss area yet, but it will start to underperform. And then you have to consider, because your edge is no longer valid, you have to consider an early exit.
We actually, ironically, we talked about that quite a bit this week with when the market started to get less uncertain, for lack of a better way of putting it, the market perceived that as bullish, but all of the trades that we had on prior to that were in consumer defensive stocks and gold. We had two consumer defensive trades on, we had a gold trade on, but then as soon as that story rotated a little bit, it was pretty quick that the gold stocks and the consumer. We had Kroger and a few, and what was the
Yeah.
other one? Dollar General, which are still doing well, but it was very obvious that the rotation changed, and then we changed with it. Today was tech in a
Yeah.
big way.
Yeah. So what we're seeing now is, things got so bad they got good. In the sense that now bottom feeder, keep in mind another thing, back to institutions, their time frame is different than ours. They might not be traders like we are. We're trying to pick directional ideas to be in for a couple of weeks, let's say, or even if we're day traders, even for 24 hours. Institutions will sit in things for weeks and stay in things because they plan on building positions for years to come. And that's something, their time frame is different. So they will stick their necks out faster than maybe we will. So when things get so terrible where we're at peak panic, right, you'll start to see capitulation. You'll start to see buyers step in. You'll start to see increased volume. You'll see little signs. Now, that's counter trend trading for us. It could be a little bit dangerous, but that's the first indication that you might get a change in sector rotation. You might start to see some of the less favorable sectors, like today, start to actually get more popular and start to outperform again like they did the last day or two. So just be aware of that happening, because now here's the good news. You can be late. You can be late a couple of days or even a week. If you wait and the sector starts to improve, there's nothing wrong with just waiting for confirmation that money is now comfortably flowing back into that group, and you can start to pick some names in that group. So that's the great thing about being a retail trader, is your size. Being small is an advantage because you're more nimble.
So, Joe, we got one more question, but I want to give everybody just a heads up. We're gonna show everybody step by step everything that's included if you're interested in working with John. Today, obviously, we're going to answer all the questions that were submitted, but I think it's kind of fun when we show you from start to finish how the entire process works behind the scenes. But we're going to answer this last question first. And I think the most important part of this is about eliminating the emotional part of trading. We just covered and showed everybody your tests format for building and scripting out and building that argument for a trade. I think it's a very unspoken benefit that when you script your trades out, you are literally telling your future self what to do. How do you feel about that?
Yeah, I mean, what's great about the test strategy is it really eliminates the emotional component. It's a step-by-step process, and every one of my trades uses the test acronym, like we just showed you. So it essentially, once you kind of know what you're doing ahead of time, it removes the emotion. The only thing you really have to consider is, is my edge gone? That's the only maybe subjective part. And that's pretty obvious to find, because if midweek, like I said, sectors start to change and there's a little bit of rotation going on, and you'll start to see it in your trade. Your trade might be staying the same or not making as much money as you expected it to. It'll just, or maybe it's losing a little bit of money, but not at your stop loss yet. You know what I mean? Maybe it's down 10%, and let's say you're at a 40% stop loss. In a situation like that, I would prefer to take my capital, my hard-earned money, and move it into something else that's outperforming. So that's where I think this test strategy is really helping people. It allows you to consider an early exit and manage your risk like a true money manager would. They're trying to get ahead of the curve in the sense that they're saying, hey, listen, the reason why I got in this trade no longer exists, or it's starting to disappear. Maybe it's not completely gone, but I liked industrials. I like CPRT. Industrials was my favorite sector about 5 days ago, but now the stock, now my trade is only breaking even. It's down maybe 5%, and now I could find other ideas. So being a good trader is about moving your capital efficiently in the right place, and that's what a lot of new traders don't realize. They try to just pick the name on television or their favorite names that they're comfortable with. And that's not what trading is all about. It's about effectively managing your money and putting it in the right direction at the right time.
So I just want to clarify for everybody, the test is actually in the trade scenario for John. So first is the edge here. So you can see target is the T, entry is the E, S, T for time frame, and then sizing. So the tests is literally the step-by-step repeatable process that ultimately, if they're good ideas, is what leads to the consistency. I think one thing that's really, it's kind of ironic, really, is the consistency that we're looking for in the market comes from the consistency with which we follow the plan.
Yep. Yeah, absolutely. You have to stick to the plan, because if you're just placing trades before you know what your target is, or before what your entry might be, or when your exit might be, you're destined for inconsistency. And now you have no plan. You're in a trade, the bullets are flying, they're whizzing around your head, and you don't know what's going on. And now your emotions start kicking in. You don't know what you're doing, because you're focused on market reaction as opposed to a plan. And that's a recipe for failure and a mental breakdown. You know what I mean? Which I've seen happen too, on trading desks. When you have a lot of things going on at once and the stress is there, you want to make this as seamless as possible, in the sense that you want to have a plan ahead of time. You want to execute that plan. You want your plan to be repeatable, simple to do, and consistent. And then you want to be able to manage it throughout the process. And that's really what this plan does.
We've been spending a lot of time this week talking about a lot of traders that put themselves in position to lose a lot of money when they create any trading plan, if they even have one in the first place, is they never allow the possibility that the trade might not work. Most people only create a plan for, here's how I'm going to make money when it moves in their favor. But when it moves against them, they're not prepared, because they never expected it to happen at all. And that's when it becomes an emotional decision. So this whole tests format and building the argument for the trade is really where the confidence and the conviction comes from, because you did the work before you even chose to take risk.
Yeah, that's really what it comes down to. You have to be prepared. Obviously, as a trader, you're always going to take on risk, but putting money in harm's way could be stressful. And to relieve the stress, to maximize your ability to make money, but also minimize your stress level, is extremely important. That's really where the longevity comes in. Because again, not one single trade should matter in your life. This is a repeatable, consistent process where if you do it over and over again, over time, you should have good results, as long as you follow the plan. And that's really what it comes down to.
So what we're going to do tonight, obviously we started tonight out talking about who this training was for. It's somebody who's got that information overload, just really doesn't understand how to consistently put good high probability trades together. And obviously somebody wants to follow somebody who's been doing this for years. We started tonight talking about some of the trades that John put on and how big they were. So what we're going to do now is we're going to walk you through the entire process of working with John. And if you're interested in actually taking the next step and getting John's newsletter and coaching and all that kind of stuff, I'm going to show you exactly what it is from start to finish. And the beauty of the coaching with the newsletter is that it's the AI coaching, which is 2 years worth of John's coaching calls, going 23, 24, and now 25. There's over 80 hours that you can access 24/7. And I'm going to show you that right now. But I think the first thing, John, I'd like to share with everybody is the top down from how the entire newsletter works and how you literally do the process from start to finish, so they understand how you get all the way to the end, where the whole newsletter is built around. And because of all of that, here's how we feel we should be looking to put together trades. So I'm just going to walk through a weekly newsletter. And actually, I'm going to use a recent one because I just think that's kind of fair to anybody who's watching the video right now. So you can see what goes into each version of the newsletter. It's broken down exactly the way John just talked about it, where first there's a market breakdown. Is anything going on with the big picture, the macroeconomic stuff? What are the institutions? Obviously, John has the institutional background, so he can see what the institutions are doing and knows what they're thinking. Then we kind of go into, we spent time before, is it time for a debit trade? Is it time for a credit trade? That's where the volatility comes in. After we've graded the market, looked at the institutions, and compared what the current volatility was, then we get over to the sectors, and now we start to grade the sectors compared to what the market is doing, work that all the way down into the correct strategy for the coming week. Again, this is not day trading. I want to be super clear about that. And then we break down the trade. I'm just going to break this down a little bit here so you can see John breaking down the market. So you get this by email, Discord, and in the member portal. Completely breaking down how we're looking at the market from an institutional perspective, where the order flow is going in and out of the market at that point, breaking down, and then ultimately to the point where we're grading the market. Now, this is very important because when you're grading the market, you're giving context to the ideas, right? Is that a fair way to say that, John?
Yes, I'm justifying why I gave the market a C- right there, which is actually an upgrade from the prior week. So I was talking about how, the reason why I gave it a C-, let's say, as opposed to a D, as, because we did bounce. And I talk a little bit about how I thought it was a pretty durable bounce on April, whenever, I think it was April 7th was the low. We had heavy volume. We had that massive rally the following day. And then we did pivot lower, but we did not make lower lows. We continued to drift a little higher. So to me, look, we're still trending lower. The moving averages are going lower. There's still a lot of bad stuff going on, but it didn't deserve a D. You know what I mean? So that's so I gave it a passing grade. And I was kind of explaining why. So this way, listen, you could disagree with me. You might read the newsletter and say, hey, I'm a little bit more bearish. But at the end of the day, it allows you to put together your basket in an intelligent way.
One of the things that we say a lot, John, is we're looking for clues. We're not looking for answers.
Yep.
And when you think you have the definitive answer, what's going to happen next, that's when you get in trouble, because you lock on that bias, or you lock on that opinion, and you kind of block out anything else. And we're kind of stacking the pros and cons to come up with the idea, and that starts with grading the market.
Yeah, based on the information that I see at that time, this is my grade. Now, that could change, obviously, midweek. If there's any new stuff that pops up, that will be addressed as well. But based on everything that we saw happen up until the point that I was typing away at that letter, this is what I'm seeing, and that's essentially what I'm justifying there.
So once John has context for the market, then we do a little bit of recon on what the institutions are doing, how are they interpreting both the macro picture, now interpreting also the earnings season, are companies beating and offering guidance, all that kind of stuff goes into building that argument and putting clues together, right? Yep. Then we get to the point where we now start to talk about volatility. So again, we talked about this in quite a bit of detail tonight. Should you be buying options, selling options? Should you be a debit trader? Should you be a credit trader? There's the volatility in the VIX, and then there's the implied volatility of the individual stocks. And we're continuing to build the pros and cons to have the argument for this particular idea. And again, John giving context. There's nothing more empowering for a trader than to know what they're looking at, why they're looking at it, and why it matters. And that's really a big part of what the newsletters are all about, because you don't just want to be regurgitating any trade that we have. You want to understand it so that you can take the trade with conviction. So this is all building pros and cons and pros and cons. We haven't even gotten up to picking anything yet, or the sector, which is actually what happens next. Now we start to break down the sectors, and over different periods of time, we'll see performance, which ones are outperforming, which ones are not outperforming, relative strength, relative weakness. And now we start to form a picture of how the sectors are doing relative to the market, so we can start to now build positions, both spread trades or outright trades like we just saw before.
Yep.
And breaking that down even further, John will then give you the breakdown week by week, last week, and then how it changed into this week. So it's literally, I'm going to call it a scorecard, John. How do you see the breakdown of the sectors when you're doing it?
Yeah, I basically go through the same process that I would the overall market. I take, let's say, utilities, XLU, for instance. There's 11 of them. You can see them right there. And I compare it to the overall S&P. So I have XLU right here, and I have SPY right here, side by side. And I basically say to myself, okay, well, what looks better? What chart looks better, right? And then has there been any material weakness from the prior week? And if the answer is yes, they get a letter grade lower, or half a letter grade lower. If they're outperforming the market, they might get a slightly higher grade than the market. The market's a C minus. Anything you see there in for the week that's above a C minus means that that chart probably looks a little bit better than the S&P 500. And that's where you should be. That's the first clue when you start putting together your watch list. So out of the whole universe of 10,000 stocks, I just collapsed it into a couple of hundred just by doing that alone. We do other filtering too, obviously, to get that list even smaller. But that's your first clue. Like if it's utilities, you can see there is a B minus. And that's essentially, that's where you should be looking. It's not the most sexy sector in the world, but that's where institutions were stepping in. They were being defensive. So consumer defensives, staples were a B. Healthcare was actually doing pretty well up until that following week, but United Healthcare was down 22%. It dragged the whole group lower. So that was probably the most significant change that week, because healthcare was doing okay up until that point. But everything else, not so good. You can see, look at technology was a D, energy was a D plus. up until it had a little bit of a bounce, with some OPEC extra supply coming out on the market. So, there's all kinds of reasons, but basically at the end of the day, you look at technicals and you make a judgment call, and you try to do it in the most methodical way possible.
So once all those clues are put together, then John is also handy. It's kind of like looking over his shoulder, now giving you the strategy for the coming week. So again, this is not day trading. This is coming out early edition on Sunday, gets emailed out and posted to everybody on Monday. So you have a plan for the coming week, putting trades on and adjusting any open trades, which is actually what we're going to get to next. So midweek, usually on Thursday, John also puts out a recap and, so to speak, an update of everything that was discussed over the weekend heading into the week for trade ideas, how the market looked that week, and then breaks down how it's unfolding and any adjustments. And I think, John, I'm going to throw this out to you. How important is it for the midweek recap to be able to hear about adjustments? Because let's face it, the market this week, this is a perfect example where it looked incredibly bearish heading into this week, and now the market's floating higher and the shorts are getting squeezed.
Yeah, so what you have to do is look at the overall charts from Sunday, compare them to Wednesday or Tuesday, and decide if you want to maybe add some bullish trades. Is this bounce durable? And I mentioned that earlier last week. I think it was. So I suggested adding a couple of bullish trades. So now that we have a couple of days of proof that that's actually happening, we can maybe move the market up to a CC plus. You know what I mean? And what that means is, and again, in a theoretical basket of 10 10 options trades, now you have to consider adding maybe 2 more bullish ideas. And that will come from some of those outperforming sectors. And that's kind of how the whole process works.
And so these are the adjustments, just to be clear to everybody, this is why the adjustment happens during the week. It's not day trading. We have new information, and now we're going to talk about that new information. So every Thursday, there's an intro for the recap. There's a video recap. There's key topics broken down for you for how John is seeing the entire market and everything that's unfolding. Then there's trade updates that are also broken down for you right here, both from credit versus debit, any open positions, any new potential positions. For example, the market is kind of floating higher right now, so things are changing. And I think this is one of the most important things here as well, is each midweek recap is also a lesson. So there's mentoring lessons based on everything that happened, because we never want to take for granted that you understand some of the things, which is actually going to lead me to the next thing. So if you're somebody who wants to make money, fantastic. But if you're also somebody who wants to understand at a deeper level so you can start making these decisions yourself by following John or shadowing what he's doing in his thought process, this bottom part here, the notable quotes, is lessons you're getting every single week. And you can actually copy and paste those and turn them into your own little options trading book. Now, the obvious thing is, but what if I'm new to this, right? There's all this language and everything that's kind of getting thrown around. Well, a part of the course, a part of getting John's newsletter is you want to be able to ask questions when you need the question answered. That's where the artificial intelligence comes in. So everybody obviously knows all about AI and all those kinds of things. So we took over 80 hours worth of John's coaching sessions from his coaching program over the last couple of years, dropped them into AI, and now you can ask John a question 24/7, and I'm going to show you how it works right now. And I think I want to show you first the level of work that went into making this super easy for you. Is we've broken down every topic over the last 2 years and put them in these tabs here. And any question you have, you basically just go right into that tab for whatever that question would start with and copy and paste it into the AI to get the answer anytime you want, 24/7. So I'll give you an example. We'll copy and paste this one here about at the money options, and we'll basically drop it into the AI. And what's happening now is it's going into the 85 hours worth of coaching, and it's now going to give you the exact answer that you want anytime you want it, so that you can basically continue to learn and trade with conviction. To me, John, this is one of the most valuable resources that somebody can have working with you, because they're not only getting your updates on the weekend and Monday, your updates and your trade ideas for the week and the management of those. Now they can kind of pick your brain anytime that if you said something in the newsletter they don't understand, or maybe they saw something that they don't understand. Now this is in here 24/7. and you can see the level of depth of the answer. It's still going. It's actually going into all that. So there's constant
It's
learning.
such a game changer.
Yeah, exactly.
It really is, because
actually, just kind of like we created a AI image of you. We'll show it to you in a second.
Boy.
Yeah. So anyway, anything you need to learn, that question is absolutely in here. Whether it's a stock pick, whether it's algorithmic trading, anything is already in here for you. So I want to make it super clear. If you happen to be new to options and you want to look over the shoulder of a fund manager, not only to shadow his ideas, shadow his thought process, so that you can start to elevate how you're looking at the market, which, by the way, the conviction in the trading comes from actually understanding what you're doing. So it's one thing to follow John's newsletter. It's another thing to be able to pick his brain and ask. Let's actually pop another question in here. How should traders adjust position size around earnings? So this obviously was a question that came up on a coaching call.
It's a good question.
And right now, very relevant, right?
Yeah.
Obviously, with earnings season in full swing right now, and you can actually see the answer again that John gave during that coaching call, and you'll have the complete breakdown step by step for anything that you want. To me personally, the conviction of understanding what you're doing versus just taking trades and really having no idea. I want to just throw something out there that I think is massively important for people to understand. Raise your hand if you've ever had a position where it was a really good position and got out of it too quickly. 9 times out of 10 that happens is because you didn't have the conviction in the idea and didn't think through it deeply enough to hold it through maybe a pullback or a pause. But when you really build the argument and you understand the language of the trade, that's when you're like, no, nothing changed. I think you say it all the time, John, my thesis is still valid. There's no reason to get out. So these little things add up to the conviction to hold the idea. And that's what the AI is here for, to supplement and complement the ideas and the breakdown of the newsletter and the midweek recap.
Yeah, it helps you with the thought process, but also such a time saver, because in the past, I would have to say, oh, go back to the video. And then I would have to tell the individual person, hey, it's this video. And then you got to maybe sift through 2 hours worth of material just to get one of those answers. And here you're getting like a whole list of answers from different coaching calls. It really is a game changer. I wish I had something like this when I was learning how to do this, because it's one of those things where the information is just there and it's accessible, but now it condenses it into exactly what you're looking for at that time. And that's such a great accelerator in the learning process. It'll just take such less time now to like figure things out and to get your question answered. You know what I mean? It's just such a game changer.
And we're actually going to get into a way where they can actually ask you a question live as well. We're going to talk about that in just a couple of seconds. If you are new to trading and you do want to learn the basics of it, obviously there's a course here as well to understand the trades, because what's the point in the trades if you don't understand what you're looking at, right? Now, the difference in what this course is about, which is John's course, obviously on options. There's a lot of courses that will teach you the basics, and obviously this course does as well. But here's the difference. This course is teaching you how to use the newsletter. That's really what you're aiming for. Right? That's really the whole goal. It's not to speak Greek, although you need to know the Greeks. The point of the course is to show you how to use the newsletter. And if there's something in the course that is not explained in a way that you understand, that's what the AI is there to supplement and give you that answer right away. Now, if you can't get the AI to give you the exact answer, or maybe you just don't understand the depth of it, in just a second, I'm going to talk about how you can actually ask John that question live on a session very similar to what we're doing right now on Saturday mornings. So we just broke down everything from start to finish, the thought process, John's background, setting up the kinds of trades. So obviously, I'm actually getting private messages already right now, is getting started with John and looking over his shoulder. It's one of the most exciting things I've done in a long time, because when you combine experience of being an institutional trader with the ability to explain things simply so that they can be understood and, more importantly, implemented, and have the benefit of the AI to ask a question 24/7, it just becomes sort of a incredible journey, for lack of a better way of putting it. So what I'm really proud of right now, John, is I want to introduce an opportunity for people to work with you over the next 12 months. And I actually built this AI picture of you today.
Wow, that's scary looking.
So it's we're very proud to announce John's Options Basket newsletter and alerts. And I think, again, it says alerts, but I want to be very clear about this. Alerts and trade adjustments. It's not just here's the information up to the idea and go manage it yourself. There's feedback, which we just showed you in the update, which comes out on Thursday, which is a video and all of that breakdown. Plus, there's the AI. So I just want to give you a really quick understanding of everything that's included with working with John over the next 12 months. So there's the Options Basket newsletter. There's the swing trade alerts, which are at the bottom of each newsletter. There's the swing trade adjustments, which come out in the newsletter as well as on the weekend. There's the Options Basket course. If some of these terms and terminologies and everything we talked about tonight, you want to learn a little bit more, sector rotation, learning how to read the market, put a basket together, that's a part of the course. Then this is probably one of the most exciting things is the Saturday swing trade sessions. I'll get into that in just a second. And they are live sessions exactly like we're doing right now. So if you kind of like the way that John and I interact, you can join us on Saturday morning. By far, one of the most popular parts of our community is it's very casual. We all have coffees and we basically break down what happened in the market the week that just finished. And then we future pace the game planning for the coming week, which means we're already prepared for the next week before the week even happens. Okay?
Yes, that's the best. One of my favorite parts of the whole program. Absolutely.
And then obviously we have the Options Trading Pro coaching, which is what we just showed you. We just gave you a few examples, and there's hundreds of questions in there pre-built for you. You don't even have to do anything. You just have to find the topic, copy and paste it, and drop it in the AI. Super, super simple. And then there's two special reports, the Options Traders Black Book, which I'll explain in a second, and probably one of John's favorite strategies amongst a lot of the stuff, the poor man's covered call. We're going to get into that in a second as well. All of these things combined is a total value of $5,433, especially the Saturday sessions and the AI, probably the most richest part of this resource. But what we're looking to do now is we want to help. I mean, the volatility right now is crazy. The market's chaotic. We want to help as many people as we can over the next 12 months. So between now and you can see there April 27th at midnight, 12 months of working with John and getting every single thing we just talked about. There's a promo code that you can use. It's actually in the description below this video right now to bring 12 months of working with John down from $1,500 as the standard annual subscription down to $995. And you can actually grab that link in the description. What I want to do now, though, is I want to go through everything that we just talked about. And you can see right there, Options Basket 425, capital B there to drop that price down. Make sure you use the promo code. We actually had somebody just buy who didn't use the promo code, so make sure you use the promo code. So first, obviously, is the newsletter, 12 monthly issues that publish twice a week. Obviously, it comes out on Monday and on Thursday, delivered in multiple ways. It's delivered by email. It's delivered in our Discord community over the weekend, and then emailed out on the weekend as well as on Monday. And you can see we just walked you through everything in the newsletter before. And again, it's normally $1,495 just for the newsletter and all of John's trade ideas to shadow him for the year. But using that promo code that we just gave you, Options Basket 425, you're going to drop that price by $500. Also with the newsletter are the swing trade adjustments. And again, I can't express this strongly enough. You're going to find a lot of people that are going to take you up to the trade and then abandon you. The trade management and the midweek recap, where we talk about how things have changed from Monday to Thursday and how we're making adjustments on those ideas, how we're seeing the market is changing. And again, the last 2 days are the perfect example of this, where everything was pointing down. The market got less bearish because the tariff news got a little bit less chaotic, and the shorts are getting squeezed right now. But traders who understand how to do the sector grading, the market grading, were not caught and actually on the right side of the trade.
Yep.
Trade alerts, and don't forget the adjustments. There's all that information up to the trade and new information after the trade starts and as it updates. Obviously, the home study course, if all of this is brand new to you, they're in bite-sized chunks, super easy to get through. If you have a hard time getting through them, who cares? Drop the question into AI. AI will give you the answer 24/7. All right. Now, again, this is probably one of the most fun things that we could do. This is actually a snapshot from January. This is a big, big bonus that's a part of this program right now, which is every Saturday, other than a holiday or travel. So I want to be super clear about that. Stuff happens, we're traveling, whatever it happens to be. The Saturday swing trade sessions almost always last at least an hour. Like I said, John and I talk about how the market unfolded during the week that just finished. We talk about how you could have traded relative to what was available. And I'll give you a big mentoring tip here, for lack of a better way of putting it. A lot of people always feel I should have done better, I could have done better. And sometimes that's true. But what if it was a really, really hard week to trade, but you don't have the context to say, maybe if I only lost a little bit of money this week, that was a great week because of how crazy it was. The Saturday sessions where John and I go back and forth, and it's an open conversation just like we're doing right now. This is where the gold is, where you can speak to us during these sessions, talk about what just unfolded, and then with the back half of the call, we then start to talk about what's happening in economics, macroeconomics coming week. Is anything coming out big? Any earnings coming out? What technical levels are we looking at? Then we give you some trade ideas, and then you could post some trade ideas for us to take a look at and review them so that now you're ready for next week and especially Monday. These Saturday swing trade sessions by far are one of the most valuable parts of our community and one of the most valuable resources because they're super relaxed and we just tell it like it is and have nice conversations with each other and with you, obviously. So this is a big deal. This is a year of these Saturday sessions. That's why they're so valuable. And this is a free bonus with everything we talked about here tonight. Okay. And we also just showed you how the coaching AI works. So again, if you're a new trader or if you're somebody who knows a lot, maybe you failed and tried and you just don't understand why, John is available for you 24/7 in the AI, over 85 hours worth of coaching sessions. You got a question, you're going to get it answered like that no matter what. And if it doesn't get answered for some reason in AI, you're going to come to Saturday and ask that question again because we're more concerned with you learning and understanding what you're doing so you can puff out your chest and say, I understand it. Now it's just a question of getting better at it. That's
exactly
what you want. Okay. All right. So that's bonus number 2, the AI. Again, this is 12 months of AI, 12 months access to this. All right. Then we have 2 bonus reports that are supplemental to everything that we just talked about. And again, these are pieces of the puzzle that if you have some time, you can dig into these. The first one, John's Options Trader Black Book, is knowing exactly how to structure your option portfolio for any market conditions. And John, I know you've said this multiple times, that it's not the strategy. If it was just more information or anybody graduating from YouTube University, everybody would be a millionaire. It's how and when to put them together. And
how and when is the key.
Yeah, right at the beginning, we said, should you be buying or selling premium right now? And then we got into implied volatility, then we got into the VIX, we got into sector rotation.
Yep.
Putting them together is where the money's made.
Yeah, a lot of people overlook that step. It's real easy to just read an option textbook or watch YouTube videos on all the different strategies. I equate it to when you go to Home Depot and you buy a big old drill set, you got all those drill pieces. How many do you really use? And when do you use them? You know what I mean? So it's like you have, you might only end up using 3 or 4 of them. You have to kind of know when to use them and how to use them. And that's really what it's all about.
Report number 2 is poor man's covered calls. Now, this is a really interesting one. Most people think of covered calls when you own the stock and you're selling against that stock. This strategy, poor man's covered calls, is generating consistent income without needing to buy 100 shares of stock. This alone is worth it. Just this one thing alone for the next 12 months. Get somebody excited about this particular strategy.
Oh man, when this is done correctly, this is a game changer. This basically is going to help my brother retire early. You're essentially, instead of having to commit all your capital to 100 shares of something and selling a call against it, imagine being able to buy something that's maybe 1/3 the price of 100 shares of something. And then essentially you're doing the same thing. So think about how much capital that frees up to buy other stuff and to diversify even more than your normal account would allow you to. That's a game changer. And if it's done properly and done with the right risk management, of course, it could really add that extra. It could potentially add that extra income to your life. And it's not something. It's a passive strategy. It's not something that you're trading actively. You're dealing with monthly, if you want, weekly expirations, and that's it.
So I just want to highlight one thing you just said before, John, because it's a very personal thing. This is how you're helping your brother prepare for retirement with this income strategy.
Yeah, my brother struggled early in his career. He's battled a lot of different things in his life, and he's finally at the position now. He just recently turned 60, and he came to me a couple of years ago, and he's like, John, I'm not going to have enough money to retire. And one of the things I said to him was, yes, you will. I was like, we're going to make sure you are able to retire when you want to retire and how you want to retire. And what we started to do was, he has a self-directed IRA, and we're able to implement some of these strategies in that IRA and in his personal brokerage account as well. And again, he has a full-time job. He's not someone who's sitting around just doing this every day. He's someone who's working 40, 50 hours a week, and he's looking to eventually stop doing that in the next year or two, let's say. So, that's really, that's a game changer for him. And some of you might be in that same position where you're kind of worried about running out of money, or you're worried about not having enough money. And these types of strategies that are more passive, they allow you to kind of clip that extra coupon every month at the same time while you're still working.
So I'm going to finish up here. This is probably something that separates the way we do things, and really, hopefully, will show you how much we care. It's one thing to get started. It's one thing to have a subscription and be excited and have a membership for the next 12 months. We actually start everybody out with a one-on-one onboarding session. This does a couple of things. We get a feel for where you are as an options trader, what you know, what you don't know, so that we can point you in the direction of the parts of the program that you need to probably focus on first, so that, number one, you're not overwhelmed and you're excited about the path, because you're not just being drilled with a fire hose trying to learn everything, get overwhelmed, and you quit. These one-on-one onboarding sessions, as soon as you become a member, the very first email you get is to schedule your one-on-one session, which is done on a Zoom call, because we show you everything in the member portal. We show you how to use everything, and we make sure that you have access to everything, in addition to asking, how long have you been trading? What do you think you need that you're struggling with right now? And then we could point you in the direction of where you can get help with that in the program itself. So this is very, very important that you understand. We are first and foremost concerned with you actually using the membership. It's one thing to have it, it's another thing to use it. And we're really, really, really empowered to make sure that we help you get started, because we want you to finish. That's a really big part of what we do.
Yeah, for sure. This is one of those things where, I love our community. We're able to empower people to do this themselves in a way that, is going to be individualistic, but put them on the right path to success, for sure.
So again, you can see everything that's included here: the options basket newsletter, the swing trade alerts, the swing trade adjustments, the options basket course, which shows you how to take advantage of the newsletter, swing trade Saturday sessions with both myself and John. They're live every Saturday. Options Trading Pro AI coaching, 24/7 access to any question that you have. If you don't get answers there, you come to Saturday and we'll give you the answer. Options Trading Black Book will show you how to put these strategies together in different market conditions. Poor man's covered call. John just said he's showing his brother how to use that to retire again. And last but not least, make sure you take advantage of the promo code. This will knock it down by $500 if you take the membership and get started. Don't wait. This is something that the longer you wait, you're letting opportunities slip by. There's so much opportunity right now with the volatility. Doesn't matter if you're long-term swing trade, there's opportunity for everybody right now, provided you know what you're looking for. Because the big difference between somebody who knows what they're doing, and there's a question here about a trading plan. I'm going to give you a quote to answer that question about how important is a trading plan. I'm going to give you something, and I hope everybody would write this down. When you know what you're looking for, you're never lost. And that's a problem with people that are overwhelmed in the market, is they're looking for everything as opposed to looking for something. And that's the whole point of this program, and even getting to the point of a trading plan. When you are ready to make a decision, there's no overwhelm. You've already told yourself what to do, how much to risk, which is a part of the trading plan, which strategies, which is a part of the trading plan. And we showed you a couple of different times tonight how John breaks a strategy down and then puts it into the format and how it becomes ultimately a trade. So if anybody has any more questions, obviously type them into the chat right now. I'll be more than happy to answer any other questions you have. If not, the link is in the description below this video to get started. Again, this is not going to be out there for a long period of time. We like to bring people in, work with them, again, on Saturday calls as well as in the newsletter. Take advantage of this tonight. This is a very limited time opportunity to save that $500, which is a 33% savings on, and you get everything that you see on the screen right now. If you have any questions, in the description below, also, if you just want to talk to somebody before you sign up, email our support. The support at stocktradingpro.com is in the description as well. So first, click through, see everything that you get in the program. So check that out. If you have any further questions, you can email our support, but make sure you take advantage of that promo code that you see on the top here, Options Basket. It's actually one word, Options Basket 425, and that knocks the price down by $500 for you, provided you take action and sign up before you see that date there on April 27th. Any parting words of wisdom, John?
Yeah, I mean, I think as far as trading plans go, you know, a lot of that has to do with obviously your goals and your time frame and your personality. And there's a lot of things that go into a trade plan, which we talk about in our community. But every one of our our newsletter alerts and the whole community that we just described kind of puts you onto the path of having the right plan and the right consistency. So again, this is for a limited time. So I think it's definitely worth taking advantage of if you want to pursue this for a secondary income, if you're ready to retire, or if you're thinking about retiring, or even if you're already retired and you just want to add that extra income to your life. I think that's really the people we're trying to reach out to here. And I think it's a great opportunity to get started.
All right. Doesn't look like we have any questions here. So if you want to watch the replay, click that button again. The replay is available. Thank you so much, everybody, for being here with us this evening. Obviously, we're going to leave this on YouTube for a while, for a limited time, so you can take advantage of this. Any questions, click that link below. Email our support team. I got some people in there. I'm looking forward to seeing them on the Saturday call as well. All right. Have a great day, everybody. We'll speak to you soon. Thank you, John.
All right. Take care, everybody. Have a wonderful day.